Our first panel is the benefits of financial planning. Now, in this discussion, we're going to be talking about how mid-career investors can secure key financial benefits for themselves. Now, I'm going to introduce the panel to you guys. So if you guys could come out onto the stage, Mr. Mendels, the rest of you guys, come on out. All right. So Mr. Mendels is going to be moderating the session today, if you could just raise your hand. David is a past president of the FPA of New York and currently serves on the National Advocacy Committee. For his day job, he is the Director of Planning for Creative Financial Concepts, and he also serves on the adjunct facility of NYU, where he teaches retirement planning for those seeking their CFP certification. Next, we've got Eve Kaplan. Eve, if you could just raise your hand there. We know who she is. She's the woman there. Okay, so Eve Kaplan is a fee-only financial planner, and she's an investment manager in northern New Jersey. Eve's got 30-plus years of professional investment experience. She's opened Kaplan Financial Advisors 11 years ago, and Eve's clients are couples and single women who are in their 40s or older. We've got Grant Webster. Grant is a CFP professional with a passion for educating his clients about investing and making smart financial decisions. He holds a graduate degree in financial and tax planning and is an avid writer on financial planning topics. He has been featured in the Wall Street Journal, dailyfinance.com, and Women in Money magazine. And lastly, we've got Jason Lina. Jason has over 15 years of experience in financial services and is a CFA charter holder and a CFP. He has earned his MBA from the Tuck School of Business at Dartmouth and has received his undergrad degree from Davison College. All right, guys, the floor is yours.
Thanks very much. Good morning. Welcome all those who braved the rain. I just want to point out, in addition, that we have some geographic diversity here. I'm local here in the city. Eve is from New Jersey. But moving on, Jason came up from Georgia, and Grant here gets a long-distance award coming all the way from San Diego to be here today. So we talked about the format for this morning's program and decided we'd really work with a bunch of questions and answers that we put together that we thought would be helpful. But it's a small crowd, and if you have, there will be a Q&A period at the end, but I also want you to feel free to jump in. If you have questions, if it's going to be really lengthy, we may put it off to the end. But otherwise, if you have questions as we go along, please jump in and raise them, because it's what's interest to you that's the most important of all. So with that, let me just get started. And Eve, you know, we're here to talk about the benefits of financial planning. Isn't financial planning just an excuse to sell me stuff?
Well, just speaking on behalf of the three of us here, we're all fee-only, so we're not selling anything except our ability to help our clients solve problems and look forward. So I would say planning is not an excuse to sell things, especially not in our case. It's a chance to enlighten people, and I think knowledge is power.
You guys want to jump in with the financial planning process? Or?
Yeah, I think it's important that a financial planner should never invest your money until he or she knows your overall financial situation. So I think it's important that if your financial planner is actually selling you right away, to just walk away from that situation. A financial planner should be your guide, not somebody who's trying to sell you a product.
Yep.
Yeah, I would completely agree with Grant. I think, you know, to answer your question or address the initial question, I think it can be an excuse to sell products. It's really important that anytime you're in a relationship with a financial advisor that you understand the fee structure, how they get paid, and the implicit conflicts of interest that go with that fee structure. There is no perfect fee structure. You know, we as fee-only advisors, we try to align ourselves with the clients as best we can, but it's still not perfect. But there are, you know, commissioned salespeople out there who just use the financial planning process to sell annuities and other brokered products.
Okay. And you know, Jason, as long as we ended with you, if you continue, can you describe the financial planning process, the steps that are involved in it?
Sure. the planning process probably looks different for all three of us and for really all advisors. The CFP board actually developed I think a 6-step planning process that starts with interviewing the client and understanding the situation and then analyzing and meeting with the client. It's just 6 steps. At the end of the day, for us, the process begins with a client interview or a client conversation, because it's really a back and forth with the client, where we try to understand the objectives, the client's goals and situation, their family, their retirement objectives, their assets, their liabilities, and really get a sense for all the moving pieces. We use that information to then do what I call financial triage, which is to really assess, okay, what are the most pressing needs right now? And I think maybe we'll talk about this later, but anytime you meet with the person for the first time, there's usually going to be, there can be 20 to 30, planning topics that are, necessary to address. If I give a client 25 topics to address, it's kind of like, anybody here giving their spouse, a laundry list of 25 things to do. If you give your spouse 25 things to do, good luck with that getting done. And so what we try to do in the planning process is to say, okay, these are the 3 to 5 most pressing needs right now. Let's tackle those, and then gradually move along down the road as part of a process. So it's not we just give them a big notebook and spend a lot of hours and work and say goodbye. Good luck with this. It's really just a process.
And to Jason's point, financial planning is a process, a long-term process. It's not a product. So you can't just walk into your financial advisor's office and say, hey, I'll have a coffee and some financial planning. It's a long-term commitment. We have some clients in my firm who have been planning clients for 20 plus years. So I think it's important that it's a long-term process for you and your family.
That's great. Jason, let me just go back to you. Well, Grant, let me start with you again, even though we're ending with you. What's the best way to save for retirement if someone's focusing on that?
For me, pensions are kind of a thing of the past nowadays. So I always tell my clients their biggest assets in retirement are probably going to be their house and their 401k. So the 401k is the one you could control the most. So make sure you understand your 401k, the investment options, how much you're contributing. So if you're under 50, you could put away $17,500 tax deferred, and if you're over 50, it's another $5,500 on top of that. So utilize your employer. They usually have help with the 401k. They can guide you on the investment choices, and just make sure your allocation is appropriate for your risk tolerance and your long-term goals.
Great, thanks.
I would just add, actually, that a really big asset that is often overlooked is actually the human capital component, and that would be the client, him or herself. So if people come to me in their 40s and 50s, we're really looking at maximizing everything they can do to prepare for retirement whenever we deem that seems, good in terms of timing.
And Eve, can you give us some examples of problems that were resolved with financial planning, that you really feel that you've been able to help clients?
Are you looking at me?
Yes.
Well, I work, for example, I work with couples, and I also work with a lot of single women. Many of them are widowed, and probably the biggest single compelling thing in terms of helping anyone is working with someone who's lost her spouse. Most of the people I work with are widows, not widowers, but it's losing a spouse, it's being confronted with mountains of estate planning and other requirements, and just being lost, which I see with some of the people I work with. So they don't even know what they have in the way of assets. Maybe their spouse didn't prepare them especially well. Maybe the death was unexpected, and the wife may not be fully prepared, was never a decision maker. So it's really starting from scratch, establishing a baseline, helping my clients understand, as we work to educate them where they are right now, where they could be going, what their options are. And it's a slower process than, say, a couple coming in and then we get to work. And yes, that's also a process, but it might not be as much of an emergency.
And Jason, do you have any examples from your clients that may be a little bit less emergency focused than Eve's, but where you really found that financial planning was able to help folks?
Yeah, I mean, it really, it depends on the stage of life, clearly. I work with a lot of clients who have a lot of financial planning needs. I think most people at the end of the day do. I mean, I think it's a rare situation when someone doesn't have, a good amount of, financial planning needs. Recent example, 2014, here we have Affordable Care Act, so we have all new health insurance laws, which really changed the game for people who are retiring pre-Medicare. So someone who's retiring at 60 or 61 and has a couple years to go before Medicare, and with the rules and the subsidies, and there's actually two different types of subsidies, but we can do all kinds of income planning to try to maximize those subsidies and create a situation which is probably better than from a health insurance cost standpoint than what they're going to have when they actually turn 65 and are in Medicare. So it's that's an example, but changing estate tax rules 2 or 3 years ago. That created a real planning need for, I think, for all of us to, it depends on the type of client we work with, but unless we're working with clients who have north of, from a family of north of $10 million, $11 million, it changes the game for how we think about estate planning. So those are just two examples of that reflect the changing laws in the last 2 or 3 years.
And Grant, Jason talked earlier about prioritizing clients who have many needs and so forth. Do you have any examples that you can point to from your practice where you've worked with clients to help them do that?
Yeah, I mean, for me, a big question is, should I save for retirement or should I save for education? That's a big one from clients. Yep. And I always tell clients that make sure your retirement planning is taken care of first before education. There's loans for education, obviously, but I haven't seen a loan for retirement. So it's okay to do kind of a balancing act. It's better to start early, maybe put some money into a 529 plan for your kids. But don't go overboard and spend all of your budget on those college savings plans when you don't have enough saved for retirement, or else you're going to be living with your kids in their dorm, So it's an important balancing act, I think.
And Grant, how do financial planners get paid?
Well, I mean, there's 3 models that are pretty well known in our industry that we know well, but investors are probably pretty confused about how planners get paid. So the first one is commission only. These financial advisors get paid for making trades, built-in fees in mutual funds they sell, perhaps insurance products, annuities, pay huge fees to commission advisors. Some of these advisors are great. There's obviously a conflict of interest in some cases. So just make sure your advisor is a good advisor, not just a salesperson. The second one is a fee-based advisor. So they usually charge either a retainer or a percentage of assets under management. And they also have the ability to have insurance products for you. And lastly, there's fee-only. So a fee-only is a fiduciary. And their only income comes from either a fixed fee, hourly fee, or a percentage of assets under management. They should never sell products. They can't take commissions. So which is best? There's no really easy answer for that. Just make sure your advisor is looking out for you and not just trying to make money for themselves. And you can ask them, are you a fiduciary? Are there any conflicts of interest? Just have full disclosure from them.
Yeah, and actually, Jason, if you could just pick up on that, Grant talked about this fiduciary word, and it floats around a lot in the literature. What does that really mean when someone says they're a fiduciary?
Yeah, it probably means different things to different people. At the end of the day, when the legal definition, I guess, for us as fiduciaries is we have to work in our client's best interest. Simple as that. The commission broker model is a slightly different sentence. It's that they have to provide investments or products that are, quote, suitable for the client, called the suitability standard. And, you know, there can be a lot of suitable products, a lot of suitable investments. And so it's, you know, I think there's a big difference between the two.
Yeah, I would just add, actually, and I've written about this, but first of all, the public is really confused about the terminology, and even journalists confuse fee-based with fee-only, and they really are different models. So fee-based advisors are selling products as well as taking in fees the way a fee-only advisor would. A fee-only advisor is not supposed to split commissions in terms of getting or receiving referrals from another professional, as well as not selling products. That's it.
So it really comes down to conflicts of interest, right? Whether or not they're there.
Yeah, and I would add, too, I mean, we don't want to sit up here and sound high and mighty like we have the best fee model. There are plenty of, and Grant alluded to this earlier, there are plenty of situations where the commission model can make sense. I mean, if you think about working with a realtor to buy a house, like we all know that our realtor has conflicts of interest, right? So as long as, and the important thing is to know that you're aware of those conflicts of interest that a commissioned advisor has, and understand the ramifications. If you do that, I think you're in a much better spot.
Yeah, something to think about as well from a tax perspective. This is a question for your CPA and your advisor. Financial planning and investment management fees are typically deductible if you qualify for based on your adjusted gross income, whereas trading costs and commissions may not be. So that's a question for your CPA and advisor. You know, are you maximizing your tax deductibility for the fee that you're paying your advisor?
Okay, great. And Eve, if someone's already retired, is it too late?
Yes. No, because we advisors are now working with a default life expectancy of at least 95. So if people are still retiring at 65 or even 70, that still gives a couple of decades of living expenses and all sorts of medical healthcare expenses, and maybe nice discretionary expenses that make life more fun. But you bundle everything up and you're looking, at a present value, perhaps at the point of retirement, of needing at least $1 or $2 million. It depends on your comfort level for a couple. So let's say a couple today decides to retire, they're 65, they ideally could use $1+ million, plus they're going to have streams of income, Social Security, pensions, and there's a lot of planning involved. And even over those last decades of life, things change. So as we talked about in the beginning, planning is very organic. Planning is an ongoing process.
Yeah, and it's important too, if you're in your early 60s thinking about retiring, you need to explore all of your options for when to take Social Security, because when you take it will affect your income for the rest of your life. I had a recent client come to me. She's 68. Her husband is 67. She's still working. He is not. He's taking his Social Security benefits. And she said, when should I take my benefits? And I said, you could take half of your husband's. Did you know that? While yours continues to build until age 70. She said, I had no idea. So she contacted her local office, and she retroactively took her benefits for the last 6 months. So it was an extra $6,000 in her pocket, and she'll have that going forward until she's 70, where she'll take her higher benefit. So there's a lot of planning that goes into Social Security. It's a good time to talk to an advisor when you're in your early 60s, and then also if you're in your late 60s, there's still time to make some changes there.
I'm just going to jump in here, even though I'm not supposed to as a moderator, but on that taking of spousal benefits, be very careful. You can only do that once you've reached your own full retirement age.
That's a good point.
If you do it before then, you've blown the election that Jason was talking about, so I just want to make sure.
And also, I just wanted to quickly add that Social Security really is not empowered to give people advice. So if you don't inform yourself and or get good counsel from an advisor, you could easily be passing up thousands of dollars of benefits.
Yeah.
And I think we've all seen situations where the people at the Social Security Administration, some of them understand what they are dealing with better than others. So there's bad advice gotten there as well. They do have a terrific website, though.
Yeah,
That's true, yeah.
I was going to.
Website's good.
It is. I was going to jump in too to add to both of their points. I think just on the original question of, I'm retired. Is it too late to do financial planning? Social Security is a great example, but I think where they're getting their distributions from, where they're getting their cash flow from is another one. I mean, we talk about Social Security. That's tens of thousands of dollars in making the right decision versus the wrong decision. And the same is true for where you get distributions from. And there's the classic, okay, you take from the taxable account first, and then you take from the tax deferred and tax-free until they all run out, right? But thinking about maybe we're going to take some from all three of those in, this year in more of a 10 to 20 year planning, that's a decision that can save tens of thousands of dollars in taxes for someone who's already retired.
Yeah, or lump sum versus life annuity or joint and survivor annuity.
Absolutely.
And smoothing distributions from IRAs, the tax effect of all of that. If you just do it blindly, you could be losing a lot of money in terms of extra taxes.
Yeah, there's a paper David Blanchett, I think from Morningstar, and his Canadian colleague wrote about what we call gamma, or what they called gamma, which alluded to all of these plus some more, and how much you can add to a, basically a return on investment for these type of non-investment planning decisions.
Okay, all right, okay. So you're not too old for financial planning, but Grant, don't you have to be rich to need financial planning?
No, definitely not. And nowadays, there's an advisor for everybody. There's actually a panel yesterday. Sophia Berra of Gen Y Planning, she only works with young people just starting out in their careers. So I think that now that technology has made it so easy to be virtual, you could find a planner anywhere across the country. I have a client that I'm seeing in Brooklyn on Thursday, and I live in San Diego, so we connect virtually. But as far as being not having enough money for a financial planner, that's not true. There's different options for you. There's monthly payments. Some planners will actually do pro bono advice for you if you're just starting off in your career or don't have the money to pay a planner. And there's a lot of free resources on the web as well for that. Or
there's just engaging someone for a fee for a plan only, which could cost several thousands of dollars, and it's not ongoing, but you set yourself on the right course, and maybe you periodically visit it. And I've seen virtually 100% of the time that the fee pays for itself within a matter of months with the kind of smart advice you can get from a professional.
Yeah, I think the reality is that the sad reality is the industry has spoken to the wealthy because that's where the money is, right? And that tends to be the recent retiree. So you think of needing financial planning, that's what's been promoted is, okay, you're just retiring, you need financial planning help. I think if you think about maybe it was a long time ago, but if you think about your first day out of college on your first job, right? And you're asked, okay.
I hope you weren't looking at me when you said that was a long time ago.
No, I was looking at these.
Oh, okay, thank you.
He was looking at me.
I think it was a long time ago for all of us. It was, but you're asked, okay, what is going to be your 401k deferral, and what investments are you going to use, and what allocations are you going to use, and are you going to defer into a Roth 401k or a traditional 401k, and oh yeah, what about we've got these 4 different health insurance options. We've got an HSA, an HRA, and an FSA. And oh yeah, we've got, you can also buy long-term or short-term disability through us or group life insurance, right? So that's your first day on your first job. You're 22 years old. Think about, I didn't learn any of that stuff in college. I don't know about you guys, but I don't know the answer to any of those questions from what I learned in college. And so, as an example of someone who's not rich and not old, there's a lot of financial planning needs at a really young age. And
I just went through that with my son, who came to the conclusion that maybe his father wasn't totally useless after all, when he found out that I actually was able to help him with that stuff.
Yeah, so, the challenge is how do you, the 22-year-old with no money, how do they pay for that advice? And that's a challenge that we face in the industry. I mean, we work with a lot of our clients' kids. That's part of our offering is clients' kids are getting married, or they're buying their first house, or they're graduating from college, or they're going to college. We have sit-downs with them to go through all those important decisions. Mm-hmm. But it's a challenge that I think the industry is facing in terms of how we make that work for those for people in their 20s and 30s.
Yeah.
Right, and Jason, okay, now you guys convinced me maybe it's not such a bad idea. If you want to find a financial planner, though, how do you find one?
Yeah, I think there's really three things. Well, you can start, how do you find them?
And how do you pick a good one, too?
Yeah, I mean, the classic ways to find an advisor are referrals, and like you go to your neighbor, you go to your friends, you go to your trusted advisors, and you ask them for a referral. There's good and bad with that. There's, I think, if you're actually saying, I'm going to do an organic search, there's a couple of good websites, and you guys may have more. CFP Board has a website. I think it's plannersearch.org, but you can find it. NAPFA, we haven't talked about NAPFA, but NAPFA is an industry group of fee-only advisors. They have a search capability on their website. So, those are some website examples. But as far as once you have, you found a couple advisors that you want to interview, I think there's three things, or I point to three things, and it's 3 Ps. It's people. Who are the people that you're going to be working with, and understanding what are their credentials, what is their background, do they have experience, do you trust them, do you get along well with them, and I think too, maybe one of you can talk about this, but our industry, there's no barriers to there's very limited barriers to entry. I mean, it's like you have to be a doctor, you have to go through medical school, and you have to pass a couple exams, and in our industry, anybody really can hang a shingle without even a high school diploma. And so I think finding someone who's I feel strongly about the CFP as kind of a minimum threshold just to weed out other advisors. There's going to be great advisors who don't have it, but it's a good tool. So people. Pay, that we talked about that. How do they get paid? To understand that. So people pay, and then third would be philosophy. Does their philosophy match with yours? And that can be anything from they use active funds versus passive funds? Are they a long-term investor versus a market timer? Do they do financial planning or just investment advice? So just all those pieces, understand their philosophy and what they're doing. Who do they work with? What kind of people they work with? So I would point to those 3 things.
I'm going to just jump in here because the FPA of New York is one of the sponsors of today's program. I think our logo's up here. It's right there behind me. Yeah. And there's also a planner search on the website there as well. So you can Google NAPFA,
Absolutely.
NPFA, the National Association of Personal Financial Advisors. There's the CFP Board, which is cfp.org. And then there's the Financial Planning Association of New York, fpany.org. All 3 of them, you can just put in your zip code, and they'll be able to refer you to local people in your area, and then you can go through the selection process. Eve, do you have anything to?
Well, I refer people on sometimes, this is going back to the affordability issue, to the Garrett Planning Network. They are hourly, fee-only planners. They tend to do at least half of their revenue is based upon plans only. So they're really a very affordable and great alternative. They're maybe 300 or 400 throughout the country, and you can go to the Garrett Planning Network website, type in your zip code, and find someone.
Yeah, I think you just spend more time finding your financial planner than you did your last, planning for a vacation or something. It should take weeks, maybe months. So don't be afraid to interview multiple advisors. Ask your accountant, your CPA, who they recommend. Your estate planner is a good one as well, because I think good advisors generally work with other good advisors. So asking your trusted advisory team now who they recommend is a good place to start, I think.
Okay. And, Grant, as a mid-career professional, what would you say are the top 3 things that they need to be focused on?
Yeah, for me, as a mid-career professional, I think working on maximizing your retirement contributions, allowing for that money to grow for the rest of your working years. That'd be the first one. The second one is preparing for the unexpected. Preparing for a job loss, disability, perhaps the loss of a loved one, having the right insurance in place. And the third one is invest with tax efficiency in mind. I don't think it's what you earn, it's what you keep after taxes that really matters. So really have a tax perspective when you're making your investments. Don't just randomly throw money into different accounts. Talk to your CPA and your financial planner about how to best tax efficiently invest for your retirement.
Anything?
Go ahead.
You go ahead.
Yeah, I think I would, add to those, because those are good ones. I think, as I think through this, like, what would I advise someone? I would also say understand your spending, and there's some good tools to do that, but it's just a critical step at any point in life. But if you don't know, if I ask you the question, what do you spend, and you don't know the answer, you should do the work to put the time in to really figure that out. There's two tools that I personally recommend, and they're very different, and you guys may have some as well, but mint.com, which many are probably familiar with, it's owned by Intuit, and the other one is YNAB, You Need a Budget. They're very different in that Mint just downloads all your transactions and you can categorize and understand your spending, and YNAB is more just entry. But really understanding your spending is so critical, because when you ask the question of your financial advisor or of yourself, can I retire? The most important thing to know is how much you spend. And if you don't know that, then any kind of plan that a planner puts together for you is really not going to be worth its weight.
And a planner would help you determine that.
Absolutely.
And help determine whether your goals are realistic or not, which is the flip side of the coin. So how much money are you not spending, and is that enough to fund a house in Nantucket and, 3 or 4 other things, and maybe your advisor is going to be the spoiler and tell you that you can afford a timeshare and this and that, but if you go ahead without a plan and do what you want to do, you could outlive your assets. Nobody wants to rely on their adult children for help.
Now, you mentioned earlier that you do a lot of work with widows and with women. Are men and women really different in their financial needs?
We're completely different.
Oh, wait, we're not going into the birds and bees here now.
Well, I have a number of female women professionals that I work with, and they're really no different from professional couples. But I would say older widows do have their own special issues. And then I would just say, in general, women tend to live longer than men. Women tend to have higher medical expenses in the last decades of life than men. Women may have had a more interrupted career due to caregiving of children or aging parents. And so you put all of that together, and basically, bottom line, it looks like women have less money, but they're supposed to stretch it further. So you can only imagine, if we see a crisis in this country in the planning industry where Americans are not sufficiently prepared for retirement, how much more so is the issue really critical for women?
You gentlemen have anything on that one, or?
Yeah, I think life expectancy plays a big part in that. I have female clients approaching 100. So I think just that gap between them and their spouse makes planning more challenging. And also, women have, on average, saved less for retirement just because those years taken off to raise children. So it's kind of playing that catch-up game after those years to get back on track to where they want to be financially. So I'd say definitely they have different financial planning needs than men do.
Yeah, just to add, I think there's also a behavioral component too. Actually, I think women are, and this is not me thinking, this is years of behavioral economic research to suggest that women are actually easier to work with. They don't make the same a lot of the same mental mistakes or behavioral mistakes that men do, as far as things like, market timing. They're not as prone to that. They're not as, they're not
more conservative.
Sorry?
More conservative investors.
Yeah, exactly. And they also don't have the same sense of, I'm smarter, I'm better than men. That's not me talking, that's behavioral research. And so from that standpoint, they don't make the same mistakes as frequently as men do. So, it tends to be, a lot of times it's easier to work with women.
Yeah, they accept advice more readily, and that really is, again, lots of studies have borne that out. So, it's good for a married couple to come in, because the woman may well temper the man's tendency to just have a more aggressive go-get-'em approach on the investment side and things like that.
I will interject, though, that while women may be more willing to take advice from, that does not apply to wives from their husbands, at least in my experience, okay? Moving on, Grant, how often should you update your financial plan if you have one?
Well, I think there's definitely circumstances where you definitely should. Getting married for the first time, merging your finances together. Then on the flip side, getting divorced, separating your assets, that's a huge financial planning event. The loss of a loved one is getting more frequent these days because of the aging population. So how do you cope after losing a loved one? How do you update your financial plan after that? Having your first child, there's a study that the average cost for a middle-income family to raise a child is $250,000. That's from birth to age 18, so not even including college. So that's also a good point to update your plan. And besides that, I think at least once every 2 years, perhaps every once per year, is a good time to just look through your plan, see what's changed, and make the adjustments as needed.
Go ahead.
Yeah, I mean, I go back to what I said before. I think, and I'll tie in an analogy. I'm a college basketball junkie, and I think when I'm a Tar Heel. When you think about what a coach does at the beginning of the game, right? Get in the locker room, puts together a game plan. And it's usually not like, these are the 20 things we need to do today, guys. These are the 3 or 4 keys to the game, right? And that's kind of how financial planning starts. And then every 4 minutes in college basketball, there's an official timeout. And the great coaches, they make adjustments. So I think back to, as a Tar Heel, Coach Dean Smith was one of the, for anybody who out there who knows Coach Smith, was one of the greats at this in terms of making adjustments every 4 minutes. If things weren't going right or things weren't going to the original plan, make adjustments. And I look at financial planning the same way. That it's not every 4 minutes, but from the standpoint of life, it's a gradual process. We all talked about that. It's how often does the financial plan need to be updated? We say at least annually. I mean, it's because it's a process. So.
My clients have things that come and go, and it's really planning on an as-needed basis. That's what makes the document an organic document.
So it's not just something that you do once and you put it away, because the world changes, right?
Definitely.
This is my favorite one of all the questions, so I'm going to just sort of drop that in now because we are running up on time. But what's the number one piece of financial planning advice that you have? And I guess I'll start with Grant.
For me, it's really planning for the unexpected. So bad things happen all the time. So make sure you have all of your insurance portfolio up to date, whether it's life insurance, disability. The most overlooked one, I think, is umbrella liability insurance. So what happens if you got sued or you caused a really bad car accident? Do you want to lose all of your assets because of that one moment? So I think just being prepared for the unexpected would be my number one piece of advice.
And I would agree with that. And I would say also, from the estate planning standpoint, it's really critical to have up-to-date estate documents that reflect your needs and wishes. If you have a special needs child, it's really important to explore having a special needs trust. I mean, there are many planning issues that just fall by the wayside if you don't look in that area, and it falls into that planning for the unexpected.
I would echo both of those. I would, just add one piece of financial planning advice is start early. So, David, you've got plenty of years to go to start early. But no, it's the power of starting early. If you sit back and do the math for 5 minutes, it's amazing. I mean, starting to save at age 20 as opposed to age 40. If you save, $5,000 a year at age 20 for the next 40 years until retirement, that's roughly the same, depending on your rate of return, as saving $35,000 a year at age 40 until retirement for the next 20 years. So just the power of compounding, just the power of starting early. And so people say, well, I'm already 40 years old, or you start now, and it's just a powerful force.
And I'm going to take my prerogative and throw out one as well, and then we'll open up for questions, which is what I call David's number one law of financial planning, which is never do anything with everything. Keep things, nothing is perfect, nothing is ideal. There is no one right answer. Never do anything with everything. And with that,
Great. That was a exciting panel. We want to open it up to you guys for any questions that you may have. Does anybody have any questions out there? You, please.
should I?
Yep.
Okay. Start with the gentleman in the front here. And, oh, they do have mics. Terrific.
So thank you for the wealth of information. Just recently we have all these tax changes on estate planning. Do you see a lot of people or your own clients going back and say, wow, I was planning for $1 million back then, now I have $10 million, I can give it to my children tax-free? Are they going back to those plans and make adjustments if they have irrevocable trust in there? Do you see any issues of resolving those trusts and readjust what's inside because they don't really need that much for the tax planning anymore?
Yeah, I think it's definitely a good time to revisit your estate plan. A/B trusts were definitely used in the past to kind of get around that exemption when it used to be $1 million. So now that it's over $10 million for a combined husband and wife, I think it's a good time to look at your estate plan and say, hey, do I need an A/B trust still, or just a traditional revocable trust? And that's a good discussion for your estate planning attorney and your financial advisor to kind of work out those details. But definitely there's more gifting going on, I think, now that the exemption's been raised so high. You know, parents want to get that money out of their estate and gift it to their children so it can start to grow for them.
Yeah.
All right, you do have time. Go ahead.
Well, I was just going to add real quick. I mean, I think people talk about the $14,000 a year that you can gift, and like for most families nowadays, that $14,000 is almost irrelevant. It just requires that you file a gift tax return. But I say, like, you know, forget the $14,000 number, because you can give away $100,000, $200,000 in a year. File a gift tax return, but it's not going to, unless they change the estate law, there's not going to be an impact.
And I think also you have to pay attention to planning vehicles that will preclude your beneficiaries of current gifts just running out and blowing the whole thing. And I've seen that with a client. The mother passed away, the adult son received insurance proceeds, and they weren't sheltered in any way, and he just blew through the whole thing in about a year. So
Use a lot of trust then.
yeah, I mean, on an as-needed basis.
Yeah.
Gentleman there, and
Good morning. Enjoyed the comments. From an investor perspective, how important is it to find a financial planner or financial advisor that looks like me, that has a client base, I should say, that looks like me?
who wants to take that?
What do you look like?
Assimilation to my total assets, my age, et cetera.
Well, I think it's good to ask your advisor, you know, how does he or she manage their money? You know, what do they do for estate planning? As far as age and how much your advisor makes compared to you, that could be a conversation as well. I could say I have clients, you know, from 20 up to almost 100, so I don't think there's a need to have an advisor definitely your age, but that's up to you, I think.
Yeah, go ahead.
No, you go ahead.
Well, I was going to say it's what particular experience or niche you consider yourself to be in. So maybe you're an entrepreneur and you have your own company, or maybe you have a lot of stock options. So if you're going to an advisor who typically doesn't work with executive compensation in a very detailed manner, or has fewer clients who are entrepreneurs, then, you know, that's a good starting discussion to move around. But I think, speaking for myself, I have a pretty varied client base too, just as Grant does. So not everyone is going to look like everyone else.
Yeah, just to comment on that, I don't think it's important that they look like you, or that, you know, they are at your point of life. It goes to the specialization. I mean, it could be someone who's very different from you, but they specialize in your line of work, or they specialize in your point in the career. There's an advantage to that. I think this industry started where we all were basically general physicians, general practitioners, and now it's becoming more focused, just like, you know, medicine is today. And there's an advantage to that. I mean, if part of life, or like someone who works with just dentists, for example, there's an advantage to really knowing the ins and outs of that industry and what issues impact dentists.
I'm just going to throw in and take the prerogative as well that while I agree with everything that's been said, it's also a matter of your comfort level. And if you're going to be uncomfortable with someone who doesn't look like you, even though they have all the other right qualifications, you know, if you look at Grant, you just go, I don't want to take advice from this guy because he's too young. You know, you need to be comfortable. That doesn't mean his advice is bad. I'm not throwing stones at Grant. I'm just trying to contrast our hair color. But understand that your comfort level is important. It's not just a matter of doing what is objectively right. It's a matter of you being comfortable as well. There was a gentleman over here, I think.
You started off the session with this product and commission-based pay model versus the fee-based. I'm just thinking, is there a disadvantage? Because a lot of people, when they're younger, the first call they make or they get, I think tends to be from the commission-based people. I'm just thinking, you know, the first time I traded a stock, I called my father's stockbroker to trade a hot stock and lose some money. And then as soon as I graduated, you know, graduate school, the first call I got inbound were insurance people. And I'm just wondering if the fee-based people have a disadvantage because they're not, and you mentioned you have to start early, but there's no natural reason why you're going to start with the fee-based people until maybe later on in your career.
You want to take that?
I see plenty of people who start the way you did and gravitate to, say, a fee-only advisor who's looking at things, and then you might see turnover in products, but you might know then that there's no, you know, hidden agenda in that turnover, that the advisor has found a better construct for your life insurance, and he or she is not personally benefiting from it.
Yeah, it's a challenge for us, especially as people, they spend the first 20 years of their life working with a commission salesman, and they come work with a fee-only advisor, and they're used to that model. They're used to us calling them up and saying, okay, we're going to buy this and sell this today. Right? The first time that happens, where we actually buy something and sell something, and they don't get a call. They call us up and they say, what happened? So, yeah, there's challenges like that. I think, as I alluded to earlier, it's a challenge for our industry as to how we adopt our fee model to address that segment of the population. And one of the neat things, and Sophia, I think, runs with this type of model is a retainer model where someone who doesn't necessarily have a huge asset base, but they're making a steady income, so it looks more like a cell phone bill where they're paying $200 a month or whatever the number is to have our service, have our advice. We manage the investments. We provide insurance advice and all that. So I think the fee model is slowly adapting to address that need. It's a good question.
It's not too late, though, to make a transition.
We've got time for one more quick one. Got any more questions? All right.
If they're not, then I will take the prerogative of just jumping in on that last question again
Yep.
there. The most important thing is not the model, though. The most important thing is that you understand what you're working with. The example I like to use is if you go to a Ford dealer, you don't expect the Ford dealer to tell you, Toyota's really a better car for you. You expect them to sell you a Ford, and that's fine. And there are many fine, the four of us are all fee-based people, but there are many fine and honorable and good commission-based people. But understand what you're dealing with. When you're dealing with a commission-based person, their job is to sell you something. And as long as you understand that that's what you're working with, and which is why it works so well, particularly for younger people who often aren't in a position to pay even the $200 a month, that's fine, as long as I understand this person is selling me something, and it may very well be something I want to buy. But that it's a different kind of environment. Okay? And with that, I'm sorry, but...
Great. All right. Well, I guess we'll wrap it up there. Thank you, guys. That was very, very interesting. There's a lot to think about.